the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system.
You mean printing?
These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity.
The Fed and the Treasury together are trying to raise the FDIC insurance rate to basically infinity. This money has to come from somewhere, and while Biden said that it's not going to be coming from taxpayers' wallets, as I've said in the past, the only place that money can come from is taxes or from the government reducing their spending. But right now, the only option is for them to print because obviously we're going into a recession, so taxes aren't going to be as high as they have been in the past, and the government is not going to stop spending. So while the Fed is trying to act like they're not printing money and they're not increasing their balance sheet or anything, they have added $300 billion to their balance sheet in the last couple of weeks, and they're just getting started with the next round of QE.
Inflation remains too high, and the labor market continues to be very tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months.
That's because people need multiple jobs to pay the bills.
At 3.6%. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation.
Because it works with long and
policy
variable
decisions
lags?
will reflect that assessment.
There you go. So basically, he's just saying that inflation is still running higher than they want it to be, but that they think that interest rate hikes that they've done up until this point are going to take some time to work its way through the economy, and they probably don't have much more work to do as far as raising interest rates. So while they don't want to come around and just do a pivot because they were expecting to possibly even have to raise the amount of interest rate hikes that they were going to be doing this year and maybe even go back to 50 basis points, he just said that they don't expect to do that anymore, and it looks like he's trying to basically go back on what he said without actually doing a totally 180 and making a bunch of people panic. It looks like the market has taken this as that they're going to continue being hawkish, but it looks to me like he's actually trying to turn things around as far as what he's saying, because he thinks that a bunch of this pain is going to start hitting the market, and he might actually start to have to be pausing or even cutting rates later this year. As I said, he can't just come out and totally change his tune from what he actually was saying like a week or two ago, because that would show that there's basically a lot more damage in the banking system, and he probably sees something that everybody else doesn't see, and that would cause a panic and make the banking crisis a lot worse.
I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words.
No.
So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening in credit conditions for households
He's
and businesses,
basically
and thereby
saying
weigh
that
on demand, on the labor market,
they're
and on
done.
inflation. Such a tightening in financial conditions
But he wants to
would
sound
work in the same
hawkish so
direction
that
as rate tightening. In
think people
principle,
don't
as a
get
matter of
ahead of
fact, you can think of
themselves
it
and-
as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes maybe, some policy firming may be appropriate. So
Maybe.
going forward,
Maybe.
as I mentioned, in assessing the need for further hikes, we'll be focused, as always, on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
So basically, he's saying that they're not sure how much damage this banking situation is causing and how much tightening it's causing in the actual money market. So if this is causing a lot more tightening and meaning that they don't have to continue doing tightening, then they might do a pivot. And that's pretty much what it looked like that reporter was reading through the lines to see, because she was actually laughing at him. Yeah. Gotta let those
Could
interest
you
rates work their
explain,
way through the
um,
system.
The difference between ongoing rate increases and firming. Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing.
May and
ongoing.
some.
So we
Yeah.
clearly were, what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible
That means
that
there's not gonna
this
be
will turn
any
out to have
really-
very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time, and in principle, if that means that monetary policy may have less work to do. We simply don't know.
It's funny how he went from we're probably going to have to increase interest rate hikes to 50% or 50 basis points again, but now he just switched and went to like we might have to do some maybe.
So
Do you have concerns that the hike you did today could further exacerbate the problem in the banks?
no, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular our lending facilities, the discount window, and also the new facility.
The debt? Did he just say debt? What the hell? That's what he should be focused on, yeah. So while they didn't change their projections, and it does look like they are still sticking to their story that they might do another 25 basis point rate hike, to me it looks like they're actually not going to be doing that, because he is switching to really dovish terms like some and maybe. He just reiterated may and some, and so like I said, it looks like they're trying to flip their tune, and I think that he's actually trying to get people used to the idea that they might actually do a pause in the next meeting.
Nick Timmeros of the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and, the people who write the minutes will be very carefully counting, but I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that turned out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that.
I was talking about that.
in their SEP forecasts. I think there may also just have been. Remember, this is 12 days ago. We're trying to assess something that just is so recent, And it's people, it's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December.
He's
In a
basically
way,
trying to open the door for a
the
pivot
data
right now.
in the first part, the first 5 weeks of the intermeeting period, pointed to stronger inflation and stronger labor market. So that pointed to higher rates, and then this latter part, kind of the possibility of credit conditions tightening, really offset that effectively.
Yeah, he doesn't want people to lose confidence in the Fed, but he does want to obviously wants to pivot.
I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
And the final point, can we feel confident that these weaknesses don't exist elsewhere, given that
You
they've
really
obviously
almost
hit the bank?
dodged that one, huh?
These are not weaknesses that are at all broadly
That's
through
right.
the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know, obviously, they were on this issue, but nonetheless, this still happened, and so that's really the nature of the of the review, is to discover that.
He nervous as hell. He keeps having
Michael McKee from
Freudian
Bloomberg
slips.
Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies.
I think this is as close as you could possibly get to saying that there might be rate cuts without actually saying it and sounding weak in this meeting.
Tighter credit conditions. So that we're looking at, and it's highly uncertain how long this situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Exactly. He doesn't want people to doubt that they have the ability to get the job done.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky, so do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things, and
print the money.
We have responsibility for price stability. The Federal Reserve has responsibility for that, and nothing is going to change that. So,
but you're not going to achieve it if they keep just spending all the money.
And if I could follow on that, but they're working. The spending that's happened is working against what you are doing, right?
Exactly.
So it's prolonging inflation.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on
It already is.
The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we
It's not gonna be
we don't
temporary,
see
just like,
ourselves
neither was
as
inflation.
running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working.
Dude,
And of course,
you can look at
we're
the graph.
We're always prepared to change that if that changes, but we don't see any evidence that that's changed.
He's just lying. It's just a lie, straight up.
The speed of the run, it's very different from what we've seen in the past, and it does kind of
A
suggest
digital run.
that there's a need for possible regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening.
Oh, so they're
Can you
gonna
confirm
like,
whether or not the board knew
make
about
it,
these
like, illegal to
escalations
pull your
by
money
the
out, or what? What the hell are they
examiners
talking
in San
about?
Francisco?
I will have to come back to you on that. Yeah, I don't know.
Boy, enter Fed
Simon
now.
Rabinovich with The Economist. Thank you very much. Chair Powell, you stated twice today that all depositors'
Here
savings
come
in
the
the banking system are
CBDCs,
safe.
baby.
Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that?
Dude, we're
And just by way of
done.
example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors? Thanks.
Well, I'm not saying anything more than I'm saying. So, but what I'm saying is you've seen that we have the tools to protect depositors when there's a threat of.
You don't say, right?
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened? Thanks.
I bet he did.
Sure. So
yeah.
that was really the Swiss government. We of course were following it.
Yeah,
over the
but
course
it
of the
could have a
weekend, and
huge
we were
contagion
engaged
effect.
with their authorities in the way that you would expect.
Tsunamis,
you would
man.
expect. It
Across the
seems
whole
to have been a
global
positive
financial
outcome
system.
in the sense that the transaction was agreed to, and it has been the markets have accepted it.
We're
and,
dumping.
it seems to have gone well, and I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well so far. I mean, there's really we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, as I'm sure you have, you can see that if the central bank doesn't get inflation back in place, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard
that's
to
what's gonna
invest
happen.
capital. It's hard for an economy to perform well.
I mean, it's
and
already there, really.
That's
It's
we're looking
happening
to
now.
avoid that, and and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
Curious how you view financial conditions now, and if
Yeah,
credit were
okay.
to tighten enough, if that would prompt a rate cut.
So, financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused
Yeah,
a
that's
lot
not
on
a no.
rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, what will be the extent of it, and what will be the duration of it? And then, once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. And so, we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions.
So yeah,
I mentioned with rate
basically-
cuts, rate cuts are not in our base case, so that's all I have to say. So, thank you very much.
Sheesh, dude. I think he was trying to look tough and act like he was still going to be hawkish, but in my opinion, he just really showed how weak he is, and I believe that we are probably going to be seeing a pause next month or in the next meeting, which I think is on May 3rd, and then we're going to be seeing probably a pivot in the next couple of months after that. He really just said, basically, he just was as dovish as he could possibly be without totally losing all credibility. He's trying to put uncertainty into people's heads, and he just said that they might even be able to do rate cuts if the banking crisis was to have more effect than what they expect, and it has a tightening effect. Like I was saying in some of my previous videos, whenever the banks go down, they have to sell the bonds, and that's basically what the Fed is doing, that's tightening monetary conditions. So the banks collapsing is actually doing like a super tightening event. Basically, they're probably going to be able to do a pivot whenever the tightening has an effect on the whole economy and makes other things collapse. And with the fiscal thing, if the government continues to spend like they obviously are going to, then there's no way that the Fed can continue to raise interest rates. And they're going to have to pivot because they have to print the money. And as we continue to go further and further into debt, that is going to be way harder to service with interest rates being at 5% or higher. Right now, with us being $31 trillion in debt, there's like $2 trillion to service that for the interest, to pay the interest to the people who bought the bonds. So we're just going further into debt. There's no way that they can keep interest rates higher, or the debt is just going to accelerate. And with a compounding effect as well. So yeah, the market didn't like this. But I think it was dovish. It was as dovish as he could possibly be without just destroying his credibility, honestly. They went from saying that they were going to do more aggressive rate hikes, like possibly going back to doing 50 basis point hikes, all the way to being like, well, if the banks keep having issues and it tightens the financial conditions more than we were expecting, then we might actually be able to do a pivot and cut rates this year. But he said he wanted to reiterate that they don't expect to because, like I said, he doesn't want to lose credibility. So it's pretty obvious that, like, he's just trying to open the door for a pivot. So they're definitely going to be pausing, and then as the rate hikes that work with long and variable lags work their way through the economy and continue to wreck things, at some point it's going to break something that's systemically more important, and they're just going to have to cut rates so that it doesn't keep happening with bigger and bigger things. But this does look like a rising wedge to me that we broke down out of, and this is also, there's a huge bearish divergence here on the hourly chart and the 4-hourly chart that we just broke down from. On the daily chart, we're also curving to the downside on this MACD with these bars turning lighter colors and starting to converge on themselves. Also, it's coming down from the overbought territory. And really on this 4-hour chart, this whole thing is a bearish divergence right here, indicated by the top of the wedge there. But I don't know, this wedge didn't exactly touch this side 3 times. It kind of just rode on it right here, so 2 touches don't really make a trend, so it's kind of hard to say for sure if that was a valid wedge there. I would say, I don't know though, it kind of did go, it touched here and went back to touch the other side before breaking to the downside. But usually you won't get a higher high after the breakdown. So it is kind of hard to tell if it'll go all the way back to the bottom of the wedge. I don't know. But then there's also there's a CME gap down here which is $20,000. So it could come down to fill this out because, as you know, it'll almost always come to fill the gaps whenever you see one. I mean, we haven't even filled this gap. So we probably will at least fill this one before maybe even coming back down to here to fill this one. On this Master Kenobi thing, the master plan, we still haven't come back down to retest this retest zone. So that could be if we did fill that CME gap, we would definitely come into the retest zone. And if we're going to, then honestly, the faster we get it over with, the faster we can start going to the upside, I think. So maybe we come back down to 20,000. I think if we came back down to 20,000, everybody would be like, you see, it was a bear or a bull trap. Everybody is an idiot for FOMOing in, and then people will start to capitulate. Everybody would be so terrified if that happened. But honestly, it would probably be just another great buying opportunity. As a matter of fact, it would definitely be just another great buying opportunity. Dogecoin has these huge wicks that I feel like it does fill wicks like that. So I think, like as you can see back here, obviously every time there's a huge wick like that, it almost always fills it up. And it didn't even get overbought really. So maybe we will go up and fill these wicks up. The Bitcoin dominance got pretty overbought, which is, I mean, it's not overbought technically because you can't buy dominance, but you know, it works the same. It went up to extreme levels, and so it could probably cool off. Maybe Dogecoin and some other things will run while Bitcoin has a cool off here. Also, sometimes whenever things move so quickly like this, then TA doesn't work as well. So sometimes these patterns might not, like if there's a 60-something% chance that it'll work, then it might not work because it's trying to cause max pain for people in the market. And if everybody's saying that there's this pattern forming and it's going to do this one thing, then it might just do the opposite to cause max pain. 60-something% does not mean 100%. So if I move this extension up, Fibonacci, then you can see we haven't even came back down to one of these lines, a support line. Actually, this 0.236 one is almost exactly at this orange trend line. So in the best case scenario, maybe we'll bounce off of that and go higher. Maybe we could turn it into more solid support before going up. Because that's also this 54-hour moving average. These daily moving averages are way down here, though. So maybe if we came back down here, that would actually be like right where those are. So maybe we'll come back down here and catch up with the 20-day moving average or the 50-day. If we did come down and fill this whole wedge out, then we would be going down about 18%, which isn't that much. That's pretty healthy and average for retracement. And then if we came down to fill that CME gap, back down to 20,000 roughly, then that'd be about 30%, which still isn't that much. That's also pretty average. I mean, it's not as average as the 20% ones, but they happen a lot. And it just makes people panic. And then whenever it pumps again, then people are like trying to chase the pump. So yeah, after this huge pump that we've just had of about 45%, I think it's healthy to have a retracement of about 20 or 30%. But definitely that would make people panic. It might bring the daily RSI back down to oversold even. which means that on the next one, maybe we could pump to like 50,000 or something like that. Because we almost got to 30,000, pretty close. So I don't think 30,000 is going to be that hard to get over whenever we do start going back up. And maybe it's not going to be even as much as I think. Like, it could bounce off of this orange trend line right here, like I said. But I was saying in my last video about this wedge and that we could be coming back down. This is Ibisu. He's named after one of the 7 lucky gods of Japan. According to legend, he will bring wealth and prosperity to anybody who evokes his name. So don't forget to write his name in the comments or you'll bring dishonor to your whole portfolio. And check out this video right here. Say goodbye, Ibisu.